Hello and welcome to another video, another episode, or whatever you want to call it, of Coffee and Stocks. I missed you guys. Today we're going to talk with Cathie Wood. Well, we're not going to talk about it. She made a video and I'm going to show you guys what she talked about, a little bit of a highlight. So you guys pay attention to what she is saying because it's very, very, very important on the upcoming election, on, certain news on certain sectors. But before we get started, how about we get some coffee? All right, so I just want to get one thing straight, and that I'm not a financial advisor, so please do not take my words as advice, because obviously I'm not a financial advisor. Don't forget to drop a like in this video as well as to subscribe, because honestly it does go a long way in supporting the channel. Right, so let's just see who Catherine Wood is. She is an ARK Investment Management. As an investment advisor with the U.S. Security and Exchange Commission in January 2014. Prior to ARK, Cathie spent 12 years at Alliance Bernstein as a chief investment officer of global thematic strategies, where she made $5 billion. Cathie joined Alliance Capital from Tupelo Capital Management, a hedge fund she co-funded, which in 2000 where she managed $800 million in global thematic strategies. Prior to her tenure at Tupelo Capital, she worked 18 years with Jennison Associates as chief economic equity research analyst, portfolio manager, and director. So pretty much she's smart, right? So whatever she says, you best pay attention, right? So let's go ahead and get started with this video. All right.
We wanted to give you an update on what we're thinking about fiscal policy, monetary policy, market indicators, economic indicators, and the impact of the election on at least innovation strategies around which we have focused all of our research. The stimulus package, there's a lot of wrangling over it, and we do know that airlines will be the beneficiaries of this next stimulus. And Lord knows they need it, because airline travel has been decimated and is coming back very, very slowly. I will say, however, that we are just anecdotally walking around and going to restaurants. We're hearing a lot about labor shortages in restaurants and retail establishments, because even though the stimulus or the increment to initial unemployment insurance claims has dropped by roughly half, that's still enough to keep people at home and to keep them from returning to jobs that are open. So it's a bit of a conundrum, and we did see today in the employment report, one of the strongest categories was restaurants and leisure and hospitality. So we do believe there will be another stimulus, and we believe it will come before the election, and that should reinforce or reassure some investors who think this is absolutely necessary. We think the economy has hit escape velocity, and that some of the stimulus that is being bandied around is probably not necessary. We also, in terms of fiscal policy, hope that that these policies are not going to get in the way of so-called creative destruction. And what we mean by that is disruptive innovation tends to take off during difficult times. But if companies and industries are being subsidized just to hang on a little longer, that's probably not good for anyone. There are a lot of jobs cropping up right now in the innovation space just because the COVID crisis has unleashed innovation at a rate we never expected to see. And as you know, we expect a lot from innovation. On monetary policy, well, M2 growth is still growing, is still 25% on a year-over-year basis. That is spectacular growth. We don't know what it means yet. I know that it's going to end up somewhere. Many would say it is ending up in the housing market the bond market. You'd be surprised when I get into flows later how little has entered the equity market, which is actually quite reassuring from an equity investor's point of view. So we know that, and just the outstanding question is how much of this will flow into inflation. In some ways, it already is. We know that lumber prices from their low in March have had tripled. So going from $300 to $1,000 roughly. And they have come in, and we'll talk about that later. But that is a harbinger potentially of what could happen here, that the money will flow to those areas where demand is very, very strong. We're not really seeing it in energy, for example, but lumber, because of the boom, the outright boom in housing, has enjoyed a big run here. We know that retailers, for example, like Walmart, are increasing wages. I think they took the minimum wage up to 15% within the past year or so. And they just announced an 11% boost in the last few weeks. Now, I don't know if that's across the board, but that's quite a bit of wage inflation. And as many who might recall the 70s, that's when I started in this business, the concept of wage push inflation dominated the discussion. And in fact, when inflation got into wages, it did become much more embedded in the system. And of course, many are focused on the so-called K-shaped recovery. And I believe that every recovery is K-shaped, that innovation takes root during tough times, especially recessions, and that the disruption associated with innovation, otherwise known as creative destruction, also occurs, and perhaps at an accelerated rate. Relative to the market as a whole, the financial services sector, I think, is back down near its March lows. Many would suggest that that means trouble for the economy and for the markets going forward. But we believe that the financial services sector is probably right in the teeth of creative disruption associated with digital wallets and disintermediation generally because of fintech, the fusion of financial services and technology. So we're not looking at the drop in financial services relative to the rest of the market as a bad signal. The manufacturing sector is on fire. Expectations for the manufacturing job increase were 35,000. What they delivered was 66,000, a nice acceleration from the previous month, which I believe was 29,000. And so what this confirms is something that we've been talking about for a while, is that businesses are having to scramble to catch up with consumer demand. And average hourly earnings are continuing to support consumer demand. They were up 0.1% month to month, which isn't a big increase, but still on a year over year basis, they're up 4.7%, very strong by historical standards. And the other number that came out today was durable goods orders. This is the best indicator of capital spending. One component of it is, and that was the non-defense capital goods, ex aircraft. It was up almost 2%. Now that's month to month, that's not annualized. This is another indicator that businesses are starting to scramble to keep up with demand, first of all, and maybe to embrace some of the more innovative ways to serve their customers. And the other good indicator is another number we got this week, and that's the saving rate. So the saving rate did drop from the 17-18% range down to 14%. That sounds like a lot of the consumers used a lot of firepower. But the consumer saving rate, if you draw a line towards the higher end of the range over the last 10 to 15 years, has been 8%, which is where it was in March before the coronavirus hit. And so that movement from 14% down to 8% could mean significant strength in consumer spending going forward. Okay, so finally, getting on to the election. It is within a month now, and so the markets are focusing very seriously on it. We have taken a point of view about innovation specifically, depending on who wins. The first thing I'll say is that the innovation that is in place right now, based on the 5 major innovation platforms around which we've based all of our research, and they involve 14 different technologies, those have hit escape velocity. They are on their way. There is nothing that the coronavirus crisis turbocharged the move towards these innovative platforms. And we don't think there's any looking back from there. So that's good news. Now, we do need to address the difference between a Biden and a Trump presidency. As far as the Trump presidency goes, we have an idea of what will happen because of the first administration, his first administration. We're probably going to see lower taxes of all kinds, at least proposed, whether that's capital gains, income taxes, a movement towards a flat tax, estate taxes, and maybe even more corporate tax reform, which may streamline the tax code to the benefit of some and to the detriment of others. And so more of the same is what we'd expect, as well as more deregulation. With a Biden administration, given what we're hearing from former Vice President Joe Biden and Kamala Harris, we know there will be higher tax rates of all kinds. And there probably will be a lot more deregulation. I mean, not deregulation, an unwinding of the deregulation and more regulation. Now, just from a pure incentive point of view, we think this will hurt future innovation. And in fact, what it could do is add more momentum to the innovation that I just mentioned has hit escape velocity, because corporations and consumers are probably going to have to look for ways to save costs if their taxes are going up. And we know that innovation is a surefire way to cut costs. It's usually cheaper, better, faster, more productive, more creative in terms of evolving new products and services. So it actually could help those. But we do fear what would happen to future innovation. And what we think could happen is that it would shift to other more tax-friendly regimes in other countries. We've seen this already with blockchain technology. We know that some American investors are not even welcome to participate in some funds that are based in Europe and elsewhere, just because of the different regulatory regimes. And we do feel this would get worse. So from our point of view, given our lens on innovation, we're hoping that whoever is elected, that this recognition that innovation is going to help get us out of this mess, we hope that will resonate. We are sure that it will with the Trump administration. We are not sure that it will with a Biden administration, but we surely will be beating the drum out there, advocating for policies that will accelerate innovation, increase productivity, increase the generation of wealth for all, and create better paying jobs.
All right, so that was Kathy Wood telling us, what she thinks is going to come in the near future. Hopefully you guys like this video. She's very smart. If you guys want more information, I will put her YouTube link down below. She deserves all the credit. She is very, very smart. So I will see you guys next time. Oh, don't forget to drop a like on this video as well as subscribe, obviously, for the YouTube algorithm, right? And I love you all. And I'll see you guys next time on Coffee and Stocks.